Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 291 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about overconfidence, and specifically overconfidence when it comes to your investing life. Look, just like anybody else, anybody in the world, right? We can become far too confident in our own abilities from time to time, and investing is no different. And sometimes when we become too overconfident in any one area, it can lead to the demise of our performance in that particular area because we think we're better than we actually may be. So we're going to talk about how that plays into our investing lives and how that may impact you, and especially you if you are a newer investor or an investor who tries to pick individual stocks on a regular basis. So stick around for a discussion of all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcast, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan. That's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. Now, has there ever been anything that you were just like, man, I'm just really good at this. I really understand this. I am really able to do this better than most people. I know I have. I know I've had those feelings multiple times in my life. Some people may say I'm too overconfident, whatever, right? But I've had those feelings, and I wanted to share an example with you about when and how I've had these feelings before, and then how those feelings can end up backfiring on you, okay? So I've had these feelings about things like my ability to do math. Right? I know this is kind of a weird example, but I was always really good at math, okay? No surprise, I love finance, getting a PhD in finance, all those things, right? So I'm really good at math, and I know it, and I'm very confident about my ability to do math well. Right. Well, then in college, I major in finance and I minor in math, right? I minor in mathematics. And so I'm thinking, okay, I'm going to go into this math minor and I'm just going to kill it. I'm going to be just as good as everybody else or better than everybody else. And that seemed to be true for a little while, right? But then I run into all these other math majors, right? These people who, this is what they do. Okay. They do math, meaning that they were so confident about their ability to do math that they were like, yeah, this needs to be what I, focus all my time on in college. And I was like, okay, well, I'll just, I'll be better than them too. Well, turns out that wasn't always the case. Now, I still did very well. I excelled in being good at math, right? But when Calc 2 can punch you in the mouth, or any other type of math class can punch you in the mouth and humble you and show you that maybe you're not as good as you thought you were. You may still be good, but you may not be as good as you thought you were. And so it makes you temper your expectations as to how good you actually are at something, and makes you look at things with a clearer mind. And this type of thing happens in our lives all the time, right? It doesn't have to be your ability to do math well. It can be your ability to play a sport, right? Maybe you were like that in playing sports at any given time. Maybe it's your ability to do some skill and you do that skill very well, or something athletically or physically that you can do very well and you're very confident in your ability to do so, right? I think that our confidence is good, right? It's good to be confident. It's good to think that like, hey, I'm good at this. I have the ability to do this, especially if you do have the ability to do it. But we should never get to the point where we are overconfident and that we underestimate the ability for whatever we're doing to punch us in the mouth. Either literally or figuratively, depending on what exactly you're talking about. Maybe you're talking about MMA fighting, and that may be very literal that you may get punched in the mouth. But I'm talking about in a figurative way also, getting punched in the mouth, meaning you get this situation where something happens and it shocks you, right? You're shell shocked by the fact that this thing happened because you thought you were so good at whatever you were trying to do. Now, how does all this tie back to our money? Okay, I know I went on a little aside there, but how does that tie in to our money? Well, many people can get that way with their investing performance. Okay, overconfidence may be getting in the way of your investing performance. Okay, the good news is you can correct it. Right? But the bad news is that if you remain overconfident, you can absolutely get punched in the mouth. You can absolutely be in a situation where your overconfidence costs you in returns, and maybe costs you in a very real way over a long period of time. Okay, so let's talk a bit about that Again, this comes from a CNBC article that I ran across that talks about overconfidence, and we'll just go through and talk about how overconfidence impacts us, and specifically how overconfidence has impacted our investing lives, specifically in the last 20 months or so. Okay, so if you're like most people, you probably assume you know more than you think you do, even if you don't realize it. Okay, we have that proclivity to do so in a lot of cases. That false sense of security allows us to be decisive in the face of great uncertainties. But when it comes to investing, that can backfire. According to Phil Fernbach, a professor of marketing and the director of Center for Research on Consumer Financial Decision Making at the University of Colorado, right? He says that those decisions can backfire in a way that ends up costing us, right? A new academic paper that Fernbach co-authored with Daniel Walters, a professor of marketing and director at the Marketing Insights Lab at NSEED, sets out to find out why this is particularly the case. Their conclusion is a combination of biased memories and overconfident assumptions is likely sabotaging individual investor performance. Overconfidence as an investor or trader is really, really dangerous because you can get yourself in a lot of trouble, Fernbach says, okay? So we have this situation where the biased memories that we have and overconfident assumptions may be sabotaging us. So let's just talk about what may be some biased memories and some overconfident assumptions that we may have, okay? Our memories may be biased for many reasons. And it may be biased because maybe we did well during a particular time when the market didn't, or it may be biased because everybody was doing well or everybody was doing bad. So your performance didn't seem as bad or as good as someone else. Your bias can be in any type of direction when it comes to your investing, right? But our overconfident assumptions, I think, are very, very dangerous to us, right? We all have this assumption, and I use these assumptions on this show all the time, right? I talk about 10% rates of return that you can get from the S&P 500 over a long period of time. And it's not wrong that has been a fairly reliable number to hang your hat on, right? Getting 10% from the S&P 500 has not been something that is impossible and has definitely not been something that is out of the realm of possibility. But to assume that that's going to continue happening into the future can be, something that actually lets you down. Now, this isn't a bad decision necessarily that you make, but this can be a situation where you think you're going to get better than you actually do, and then you're frustrated when you don't get better. Now, another way that our biased memories can get in our head and really frustrate our investing process, right, is to say, oh, well, I have seen something like this before. Right? I've seen this exact same situation. I know exactly what's going to happen. And that's not to say that history is a bad guide. I think history is a very good guide when it comes to our investing life. Okay. But the problem with this is that sometimes the history that you are referencing is not necessarily congruent with the history that is being created at the given time. Okay, and so you try to trade or invest based on that particular set of assumptions, or maybe you're just looking at an individual stock, right? Maybe you're looking at an individual stock and saying, oh, well, the last time this happened to that stock, then, it blew up, or the last time that this happened, or whatever, right? You have these biased memories of the fact that, something good may have happened, but maybe that thing that was good wasn't quite as good as you thought it was, right? And then maybe the assumptions you have for the future are far better than what is actually realistic. I want to give you a quick example. And this is not to say that this particular company is negative in any way or that their valuation is not warranted or whatever. This is just me saying, if you hear things like this may be a situation where we have gotten overconfident in our assumptions, okay? Let's take Tesla, okay? Tesla is far and away the most valuable car manufacturer in the world. Now, we know with stock prices what happens is they price in future cash flows, right? The price of a stock today is equal to the present value of all future cash flows of the stock divided by the number of shares outstanding, right? And so people have, obviously made the hypothesis that Tesla is going to be worth a whole lot and that Tesla is going to create a lot of cash flow in the future one way or the other. But Tesla, if you look at their market capitalization, is worth more than Ford, BMW, GM, and several other car makers combined. Okay, then the question becomes, why would they be worth so much more if they're doing something similar and maybe they're not making the earnings that those other companies are making or making the cash flow that those other companies are making? Maybe it's all because of their ability to do something in the future that those other companies can't. but who's to say that those other companies can't, right? We may have overconfident assumptions based on the fact that, Elon Musk is a genius, or based on the fact that Tesla was a big first mover in the space of electric vehicles. Not that they were the first to put it out, but the first ones to say we're only going to create electric vehicles in the United States, right? So this can be a situation where we are overconfident and we do believe something to be true that may not be as true as we actually think. Again, that is not to say that Tesla might not be a good stock or a good company to own. I'm just making the statement that maybe our assumptions, maybe what we believe about particular stocks like Tesla, when it gets so outlandish, the valuations get so outlandish, maybe it's time that we actually look at how overconfident we may be about these particular companies or particular investment choices. Now, why are your memories likely distorted? When it comes to your past investment performance, your memory is likely to lead you astray. If I ask you how well did your past investments go, you're going to remember it as being better than it actually was, Fernbach said, right? That supports a belief that you're good at investing or trading despite evidence to the contrary. Now, I can give you this in my own life, right? You remember the winners. You remember the things that you did well at far more than you remember the losers, especially the losers that weren't huge losers, right? If you just, lost a little here, lost a little there, those don't hurt necessarily, right? But you want to remember those winners because you want to tell people about those winners, right? You want to tell people that you tripled your money in this or that you doubled your money in that, right? But you don't want to tell people that, you lost half of your investment on something else, right? So you'll try to forget that particular something else, and then ultimately you will, but the winners will stick around in your mind. Now, generally, people tend to remember the good times and forget the bad times. This contributes to a positive self-image. Okay, so this makes us think that we're better than we are. Now, this is in all parts of life. This is in the parts of life where we're just talking about, things being good in our careers or things being good in our education or whatever. We remember the good more than we remember the bad because we want to think well of ourselves. We want to think of ourselves in a positive light, right? That overly rosy view of the past contributes to overconfidence and can lead us into places where we make bad decisions because we don't look at things objectively, right? When it all comes down to it, that's what I'm getting at today, is that we don't necessarily look at things in an objective manner, right? We look at things subjectively. We look at things through a lens of the fact that we think we're so good, that we think we've got things figured out, right? We aren't humble in certain things that we do, and therefore we have to be humbled by that thing to actually change the way we end up acting. Now, when it comes to investing in particular, too much confidence is not necessarily a good thing. If you don't have an accurate view of the data, then you're going to have an inflated sense of your own capabilities. Overconfidence tends to contribute to higher trading frequency, yet previous research has shown that the more trading an investor does, the less likely they are to be successful compared to a buy and hold strategy, right? And this is not surprising. It's not surprising that when you think you're really good at it, you want to be in and out and making moves and doing all these things. But we've talked before that buying and holding is going to outlast, when it comes to returns over a long period of time, trading in the short term and buying and selling in the short term. Why? Because buying and holding is going to allow you to get the full scale of any upward trajectory in a particular investment, right? But if you're just buying and selling constantly, you're likely to cut off your winners too early, and you're likely to, cut your losses when something may be actually worth more, but you just didn't give it time to work out. You're trying to work a lot more in the short term. Now, at some point, the bull market ends, and a lot of the swing traders, day traders find out that it's not easy to beat the market. Okay, and I think then a good reason to have this type of talk now is because we may be in a particular situation, not that a bull market is ending, right? But that valuations are so high and so much speculation has been occurring, right? There have been so many inflows to these speculative assets like Bitcoin, like meme stocks, like all these different types of things, right? And you have to understand that over a long period of time, it's just not easy to beat the market. And the reason that is not because people before you didn't find similar securities to invest in, right? You think that there wasn't the equivalent to a meme stock back in 2000? Of course there was, right? Or the equivalent to a Bitcoin or Ethereum or crypto back then? Yeah, it's not the same thing, right? But similar types of assets that are extremely speculative that people wanted to purchase, right? This has happened. This has happened time and time again. And what ends up happening on the back end of a ton of speculation is crashes, right? And is the ending of bull markets, and is the ending of the party, because the first things to go may not be all the speculative assets, right? But when the market goes, the speculative assets go far, far harder than the market itself, right? You figure out that beating the market is not easy because, right, you think you can beat the market for some period of time. You're like, okay, the past 20 months have been just bang on great, right? You've invested in these meme stocks, you've made hundreds or thousands of % of return, and you're like, oh, well, that return will cover me for a long period of time, right? But then whatever you may be invested in when the bubble pops, right, or the party ends, right, and those things go down by half or 70%, and that's not beyond the realm of possibility because it can absolutely happen. Just look at Bitcoin. Bitcoin went down by more than half, right? And that's not to say that it hasn't made quite the rebound, because it has. Okay, but how many people do you think sold on the way down and haven't gotten back in? Don't believe that it's something that they should invest in anymore or speculate in anymore, right? And it's because those people will jump off the ship. And when those people jump off the ship, then guess what happens? They find out, oh, well, it's not that easy. It's not that easy to just jump into something and make, hundreds and thousands of % of return in a sustainable way over a long period of time. It's just not easy. Now, to be sure, investing requires a certain amount of trading. Right? For example, it makes sense to manage risk by rebalancing your portfolio periodically, and we've talked about this, right? Getting rid of some unnecessary risk. If you already know what your risk tolerance and risk profile looks like, right? You may want to get rid of some unnecessary risk and take on, some less risk on assets. Investors probably also want to update their portfolios by adding new names and parting with old ones that no longer have good prospects. And this happens too, right? If you're buying individual stocks, the story can change with individual stocks. It absolutely can. And that's not a bad thing. It doesn't mean that you failed. It just means that the story changed. And if the story changed, you may have to cut a particular position or get rid of a particular position and take on new positions with that money, right? That doesn't mean that you're too active of a trader. That just means that you made a choice that was based on the data, that was based on the objective truth, and you went and you acted on it, right? But the problem is when we're just constantly in and out of positions and constantly trying to find the next best thing, and that is what's going to end up leading you to a place where you're a short-term thinker and you're not going to be as good at something like trading as you think you are. Now, people tend to get in trouble when they fuss with their portfolios too much. If stocks are going up, they have a tendency to want to buy. Conversely, if everything's going down, they have a tendency to want to sell, which is 100% the opposite of what should be occurring, right? What's the whole idea of investing? Buy low, sell high, okay? But what are individuals doing here? Obviously, individuals are wanting to buy when things are going higher, but sell when things are going lower, which is naturally going to do what? It's naturally going to eat into returns of retail investors, of individual investors, okay? So it is going to hurt you to be too overconfident because obviously, right, in doing so and wanting to buy when things are going up and sell when things are going down, you're acting like you know something that the market doesn't, or that you're beating the market on the way down or beating it on the way up or whatever, and you're not. You're actually going to miss out on profits that you could have made otherwise. Okay, now, that type of reactive trading is really bad because it leads to a lot of selling at the bottom and a lot of buying at the top. Having a buy and hold approach to passive investments like index funds tends to perform much better over time. But in a bull market, when people can trade in and out of strategies and still have gains, the performance gap may not be as obvious. At some point, the bull market ends and a lot of these swing traders, again, find out that it's hard to beat the market, okay? So, when the market's going up, as it has been, okay, it's awesome to look and go, oh, over the last year, Google's up 70% or whatever crazy amount they're up. And that's a large company that's increased by 60 or 70%. Apple's up by a lot. Tesla's up by a heck of a lot, right? You just look over the last 10 years. Look at Netflix. Look at, the performance of Bitcoin. Look at all of these different assets that you could have invested in that have absolutely blown up, right? It's easy to make returns when things are just going up. It's absolutely easy to do so. But to think that just because you made returns on something as it was going up, right, and as the market was continuing to push higher, and as interest rates were low, and as more money was thrown into the economy, does not necessarily make you a good investor. It does not necessarily make you a good trader. And I know you may say, well, if I made money, then I'm good at it. And I guess you're right. I guess you are, right? But you can really tell who the winners are, who the best are, when it turns out that the market went down, right? Or it turns out that we're in a sustained period of moving sideways, because people forget, especially young retail traders who weren't in this when the market crashed during the financial crisis, right? From 2001 to 2010, the market basically moved sideways, right? And yes, there was a great run up into the financial crisis, but we didn't 100% make our way out of the gully of the financial crisis until after 2010. So you're in the situation where you've moved sideways for a whole decade. How would we react to doing that, right? When we're just so used to everything going up. You look at a chart of the S&P 500. I know we had a big pullback last year during the coronavirus crash, right? But we also had a lot of people who said, hey, we understand why this is happening. Let's go ahead and let's buy the dip. But how easy do you think it would have been to buy the dip when it seems like your financial system is crumbling, right? When it seems like everything is going to go to zero like people thought it would during the financial crisis, right? People were far more scared in the financial crisis based on the financial system failing. But people were just worried about the ability of businesses to do well in the short term when it came to coronavirus. And so that created some very intense selling to the downside. But ever since then, we've just been on a straightforward upward trajectory. We've gone longer than we ever have without a 5% correction in the market. And that's not even a correction, just a 5% drop in the S&P 500. What's that tell you? That tells you there's a lot of speculation. There's a lot of buying. We are in bull market mode, right? And people think it's easy to make gains. And people aren't wrong. People are probably making a lot of gains and a lot of speculative assets. But when the party ends, what's it really going to look like at the end of the day, when what you actually have shows its worth in its price, okay? Now, what to do before you invest? If you're like many investors, you're probably not aware of how a false sense of security could be leading you astray. There's a way to combat this, though. Okay. Before you make a move, look at your past performance. Based on the research, that tends to help give people a reality check as to their actual performance. Okay. So especially if you're buying individual stocks, individual securities, right? You should be deciding, okay, I'm going to buy this or sell this, and you should write it down, right? You should say, why did I buy this stock? Why did I sell this stock? Why did I do this? Why did I do that? And then you can look back later and understand your decision-making process. And maybe you'll hate your decision-making process, at which time you can make changes to your portfolio. Or maybe you'll love your decision-making process and understand that the only reason you should make a change is if that decision-making process ended up breaking, right? Our minds can change and the way we think about things can change. But if we keep a log, keep a journal of why you made certain buys or sells within your portfolio, then you may be far less likely to look back and go, oh, well, I'm just going to do this anyway. You'll be far more likely to make good decisions, far less likely to make bad ones as you move forward in your investing life. Okay, you need to understand what your past performance actually is, not what you feel like it was or thought it was. Look back at that past performance. Look back at the trades that made you what you are now, made you actually have that performance, and go, maybe I don't want to make that decision again. Maybe I don't want to make that mistake again. Right? And then you can learn. Now, Fernbach says, obviously, that we remember the winners being better than they were, and we remember the losers not being quite as bad as they were. All of these things can be eliminated by just looking at the data, looking objectively at the data, and looking at your actual past performance. Okay, the research is based on several studies of people who were actively investing from 2018 to 2020, typically with at least $1,000 in the market and at least 2 individual stock holdings. Okay, so these could be very small shareholders that they were doing this type of survey with. Ultimately, what we need to know, though, and what we need to think about, what we need to understand is that you're not going over the long period of time, right? You're not going to beat the market by speculating. And you're not going to beat the market just by YOLOing your money into things that, the meme stock traders are going into or whatever. Okay, I understand the want to just double your money quickly or triple your money or quadruple your money. I understand that. Okay, we all fall into this thought process of, oh, well, if I could just double my money quickly, X, Y, Z. Over the long period of time, that's just not going to happen. You're going to strike out far more trying to do that than you ever would trying to take a very logical approach to investing, right? If you make 12% per year, which would be fantastic long-term returns, right, you're still only doubling your money every 6 years. Okay. And when you have small amounts of money, that could be difficult to sit around and watch. It doesn't seem like your money's doing that much. It's like, oh my gosh, I feel like my money's not doing anything. But ultimately, right, doubling your money every 6 years would be a fantastic way to grow your money over a long period of time, right? Especially if you're adding to it systematically. This is why I tell so many of you guys that just investing in index funds or very low turnover, low cost mutual funds will help you over the long term to make returns that are at least commensurate with the market, and it will help you to not make bad decisions that can just eat away at your returns in a very, very real way. That's the thing. If you make a few bad decisions, they can eat away at your returns in an extremely real way. Okay, but if you're just constantly buying an index, right, you're just going to make what the index makes. And neither here nor there, you're going to make what it makes. Okay, you may miss out on the speculation, okay, but you don't understand the speculation in the first place to be missing out on anything. You just see people making money, and it's natural. It's natural to want to run to where people make money. I understand. Where people are making money, people are going to flock. Okay, but that does not mean that you're going to be good at it. And that does not mean that you are going to be effective at doing this. I think all the time about people on social media, right? It is very easy to look at social media on even YouTube or podcasts or whatever and go, oh, well, if they can do it, then I can do it, right? I've got my own podcast. I've got my own YouTube channel. I understand that thought process, right? But you understand once you're in it for a little while that, oh, these people are actually really, really good at what they're doing, and they actually, understand the game. They understand how to make money at this. They understand how to monetize these things, and they, really speak to a certain group of people who really like what they're talking about or really like what they're doing or whatever, right? And you realize that your overconfidence at looking at something going, oh, I could do that, turns into you being not that good at it, especially in the beginning, until you learn some things and have some experiences. Look, if you go back and watch my first few episodes of this show, you can see somebody who, I thought I'd be good at podcasting. I thought I'd be good at having a YouTube channel. I thought I'd be good at all these things. And those first couple episodes are pretty boring, right? The way I was talking to you guys, the way I was trying to follow a script far more, all those different types of things just made it not as good, right? I was overconfident in the fact that I could do it well just right off the top, and that was not the case. Now, you grow, you become better, you learn more, you talk more in front of the mic, you get more experience, and things can get better, right? And the same goes with our investing, okay? You should go out and get the experience. If you're young and you want to try to trade, look, nobody's stopping you, but I'm just telling you over a long period of time, that's not what's going to be most profitable for you. One way or another, you're going to learn the lesson. You're either going to learn it the easy way or you're going to learn it the hard way. And the hard way is taking all the losses along the way. And what I'm afraid of is that this overconfidence can lead us out of the market altogether. Okay, and that's not what we want at all. We don't want to be in a position where we've lost so much and we've been so overconfident and made so many bad decisions that we end up not coming back to the market because the market scared us off. I don't want you to ever think that money cannot be made in the market, because money can absolutely be made in the market and be made in the market sustainably over a long period of time. But you have to temper your expectations. You have to understand who you are. You have to be very self-aware. That's really what this all comes down to, right? Be very self-aware. Overconfidence is a lack of self-awareness, right? It's thinking that you're better than you actually are. If you're aware of yourself and know what you're good at, know what your abilities are, right, then you'll be able to make better decisions over a long period of time. So hopefully, this helps you to better, get the information that you need to make the decisions about investing that you need to make. Maybe this drives you out of just trying to trade individual stocks or, trade crypto or buy and sell things over a short period of time. Maybe this pushes you more into a buy and hold ideology, into a investing over a long period of time, doing long-term investing like I talk about on the show on a day-to-day basis. I promise you that is going to be more profitable to you than anything else you could try to do. I'm not saying that it's impossible to hit big on a stock. I'm not saying it's impossible to hit big on crypto. I'm not saying it's impossible to make huge returns. I'm not saying that's the case, because people have, and people who don't know what they're doing have. Okay? People who don't know what they're doing have absolutely done that. And that is what drives you and me to want to do it as well. Because you're like, if they don't know what they're doing and they make money, then I can do it too. It's a fallacy. It's not going to happen for the vast majority of individuals. So I implore you, do the things that work, do them over a long period of time, invest aggressively with the amount of money that you put away, and you will not be disappointed with the returns that you get, and you will not be disappointed with your ability to grow your money in a sustainable way over a long period of time. Stick to that, and you will become wealthy. Stick to that, and your investment performance will be a good investment performance relative to the market over a long period of time. I hope that for every single one of you, because that's what I'm doing myself. Is it easy? No. But will it be worth it? Absolutely. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you're interested in financial coaching sessions, and you and I can begin working together, pushing towards your long-term financial goals and ultimately pushing you on towards long-term financial freedom, which is what I hope for every single individual watching or listening to this show on a day-to-day basis. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.